Hi everyone, welcome again now to our third session of financial accounting, whereby in this session we are going to look at recording business transactions. Therefore, you can have your book, your pen, and your calculator. Thank you. So, what is the first thing we are going to look at? We are going to look at source documents, and therefore, what are source documents? Source documents are original records that provide evidence of business transactions. They are essential for recording transactions in the accounting system and serve as proof for audit, internal controls, and financial reporting. So when you want to start recording our transactions, we need to know where are we going to get this information, the source, the origin, what will provide a proof or evidence of business transactions. In this case, we are talking about source documents, and some of the source documents include: number one, we have quotations; number two, purchase orders; number three, statement of account; number four, remittance advice; number five, receipts; number six, petty cash vouchers; number seven, sales invoice; we have number eight, purchases invoice; 9, credit notes; 10, debit notes; and also we have bank statements. Now, let us start with quotations. What is a quotation? A quotation gives a potential buyer the cost estimates for goods or services before they commit to buy. So, when you want to buy an item or some goods, that document that you commit or you get before you commit to buy is what we are calling quotation. And the key features are price breakdown, e.g. we have labor, materials, we have validity period, e.g. 30 days, and we have delivery timelines. For example, let's take an example of a printing company in Nairobi which sends a quotation to a school for branded exercise books, breaking down costs like design, the printing, VAT, and delivery. So we are saying that this quotation will give the potential buyer the cost estimates. If they want to buy maybe certain amount of goods, they will be able to know the price, they will be able to know the estimates of those goods before even they commit to buy. We have the other one, which is a purchase order. A purchase order is a formal document issued by a buyer to request goods or services from a seller. Key points: we have list quantity, prices, and products or service details. We have becomes a legal agreement once accepted. We have helps track and manage inventory and purchases. Let's take an example of a county government which issues a PO, that is purchase order, to a construction firm for road repair materials. So before this is as we are saying, this is a formal document that is issued by a buyer to request goods or services from a seller. Now we proceed with our number 3, which is statement of account. What is a statement of account? It's a summary of all financial transactions between a seller and a customer over a period. It includes opening and closing balances, invoices issued, and you have payments made. Let's take an example of a company which sends monthly statements to postpaid customers showing call charges, data usage, and payments. We also have a remittance advice. This is a notification from a buyer to the seller indicating that payment has been made and what invoices it covers. For example, we can have a supermarket which sends a remittance advice to a supplier confirming payment for 3 pending invoices for their delivered goods. Then we also have a receipt. What is a receipt, or what does it concern? This is a proof that payment was received by the seller from the buyer. And we have details will include, or a receipt has the following: date, amount, and payment method. Maybe was it cash, was it money, or I mean M-Pesa. We have names and receipt number. For instance, let's look at or take this example of a customer who receives a receipt from Naivas supermarket after paying cash or by M-Pesa. Then now we have our number six, which is petty cash voucher. Now we ask ourselves, what is a petty cash voucher? It is used for small cash expenses that are impractical to pay by check or bank transfer. It includes date, amount, purpose, and recipient. It must be supported by receipts. For example, we have a receptionist at a law firm is reimbursed 200 Kenya shillings using a petty cash voucher for buying airtime to all clients. We also have a sales invoice. What is a sales invoice? It's issued by a seller to a buyer detailing what goods or services were sold and the amount due. It includes date, amount, item description, and invoice number. It's good to note that for the sales invoice, mostly it's used for credit transactions. Let's say person A sells goods to person B on credit, meaning no money was paid by the buyer. Therefore, the seller will issue a sales invoice detailing what goods or services were sold and the amount that the buyer is supposed to pay to the seller. For example, a car dealer which issues a sales invoice to a customer buying a Toyota Probox. Also, we have a purchases invoice. What is a purchases invoice? It's sent by a supplier or a seller to the buyer to request payment for goods or services delivered on credit. So we have a good example is a Kenyan example of Quickmart, which receives a purchase invoice from Coca-Cola Kenya after receiving a new stock of sodas. We also have a credit note. What is a credit note? This is issued when goods are returned by the buyer or to offer a refund or discount. In other words, a credit note is used to correct an overcharge. Mostly you may find that a buyer who buys goods on credit is number one, maybe overcharged. Maybe they bought goods of worth 200,000 and the invoice is reading 300,000. Or maybe this buyer bought goods and maybe some of them were broken and they returned. Therefore, they receive a credit note whereby it's used to correct an overcharge. An example is a hardware store which issues a credit note to a contractor who received extra bags of cement that were not needed. So you may also find that you've received more goods that maybe that you needed as a buyer. Then now we have the debit note. So, what is a debit note? A debit note is sent by a buyer to a seller when the buyer returns goods. It's also used to request a credit for the returned items. In other words, a debit note is used to correct an undercharge. A good example is a school that sends a debit note to a stationery supplier after returning defective markers. We also have a bank statement. This is a periodic summary from a bank showing all transactions, that is, deposits, withdrawals, charges over a given period. A good example is a business that downloads their Equity Bank statements to reconcile their records before preparing monthly accounts. So those are some of the source documents, or what we are calling the documents that form a proof or evidence of business transactions, that is, quotations, business orders, statement of account, we have remittance advice, we have receipt, petty cash voucher, we also have sales invoice, purchases invoice, credit note, debit note, and bank statement. Also, we have some questions there that can form as review questions about the source documents. Thank you for listening. Thank you for being with me for the session. Let's meet next time as we look at books of original entry. Thank you and bye bye.